Look at the structure of this standard chart. To navigate it, traders are required to memorize over 100 distinct context-dependent formations, scanning constantly for a bullish engulfing, a morning star, or a harami. Because no two chart setups are identical, identifying these patterns relies on individual visual translation. The rules are highly flexible, forcing the trader to manually weigh the context of every single formation. When capital is on the line, human psychology often interferes with data analysis. Relying on subjective visual translation in a high-stakes environment leads to inconsistencies that limit an analyst's accuracy over time. There is a structural solution to this subjectivity problem. It is called Heikin-Ashi, which translates from Japanese to average bar. Developed originally in Japan, the technique reached Western traders in early 2004, when it was introduced to the quantitative community by analyst Dan Valku. Heikin-Ashi functions as a deterministic mathematical filter applied directly to standard open, high, low, close data. By applying this formula, a system requiring the interpretation of over 100 different patterns is reduced to a framework defined by only 3 distinct candle types. To read the output accurately, we must deconstruct the 4 formulas building a single Heikin-Ashi candle. On this split screen, we translate raw data into the filtered bar. First, the Ha close is the mathematical average of the current standard bars open, high, low, and close. Next is the Ha open. This anchor is plotted at the exact midpoint of the previous Heikin-Ashi candle's body. Finally, the Ha high and Ha low boundaries snap to the maximum and minimum values present in the current period's raw or calculated data. Because the opening price is anchored to the center of the previous bar, the visual output is smoothed. This specific mechanic reduces the visual price gaps that frequently trigger false panics on standard charts. By running this algorithm continuously across a timeline, price action conforms to 5 structural rules. This chart illustrates Rule 1. An unbroken sequence of green bodies identifies an established uptrend, while red identifies a downtrend. Rule 2 dictates strength. Upward momentum scales with the green body's length, reinforced by the total absence of lower shadows. Standard candlestick charts frequently print opposing colors during a dominant trend due to minor pullbacks. These signals can lead undisciplined traders to exit their positions prematurely. In the Heikin-Ashi framework, a perfectly flat bottom indicates that the average price remained above the midpoint of the previous period. This absence of an opposing shadow provides a quantifiable measure of momentum within that specific time frame. As a powerful market trend eventually exhausts its kinetic energy, the Heikin-Ashi algorithm visualizes this rapid rate of deceleration. Rules 3 and 4 map this exhaustion. As the current price struggles to pull away from the historical average of the high open, the candle bodies shrink. Upper and lower shadows begin protruding simultaneously, signaling consolidation. Rule 5 defines the potential reversal point. It is flagged either by a shift in body color or the emergence of an HA doji, a compressed body flanked by long upper and lower shadows. On a Heikin-Ashi chart, an HA doji demonstrates that the mathematical forces of supply and demand have neutralized, bringing the momentum of the previous trend to a statistical standstill. To see how these rules perform in live markets, look at this daily chart of the Euro-USD. We see a strong, flat-bottomed uptrend that eventually compresses into an HA doji at the peak. The system has a structural limitation. Because the calculation for the HA open relies on historical averages, Heikin-Ashi charts lag behind real-time price action by roughly 1 bar. Analysts compensate for this lag by synergizing the Heikin-Ashi sequence with momentum oscillators to independently verify the reversal. Here, the HA doji aligns with the relative strength index declining from an overbought threshold and the MACD executing a bearish crossover. Stacking a noise-filtering price chart with leading momentum indicators establishes a robust system for identifying high-probability entries. For high-frequency environments, analysts apply an advanced quantitative metric to reduce that structural lag even further. It is called Ha delta. Ha delta isolates the momentum of a single period by calculating the difference between the Ha close and the Ha open. By plotting Ha delta against its own simple moving average, analysts can track the precise moments the two lines cross. These crossovers generate warnings of a momentum shift before the visual candle on the chart changes color. Standard chart reading often relies on intuition and visual memory. By applying an algorithmically smoothed interface, Heikinashi reduces the psychological noise of the trading floor, shifting the trader's focus away from subjective pattern recognition and moving toward a much more structured analysis of objective mathematical trends.